There is a purchase Charlie Munger makes before he ever looks at a stock price, before he checks the growth rate, before he reads a single line of the earnings report. It happens quietly in his own head, and almost no one else does it first. Most people buy hope. They buy a story about the future and hope the numbers catch up later. Munger buys something else entirely, something so unglamorous that most investors skip right past it, and skipping it has cost people more money than any market crash ever has. What he buys first is not excitement. It is not opportunity. It is a boundary. A line drawn honestly around what he actually understands, and everything outside that line gets left alone, no matter how tempting it looks. This one habit, done before any dollar is spent, explains almost everything else about how he built one of the most respected investment records in history. And once you see it, you will notice how rarely anyone else does it, including people managing your retirement savings right now. Here is why this matters more than it sounds like it should. Every year, smart, capable people lose enormous amounts of money, not because they were foolish, but because they were confident about the wrong things. They understood enough to feel safe, but not enough to actually be safe. That gap between feeling informed and being informed is where fortunes disappear, usually without warning. Munger noticed this pattern decades ago, and he built his entire approach around closing that gap before it could hurt him. By the end of this video, you will understand the exact order of purchases he makes in his mind, the questions he asks before questions like, will this go up? And one particular idea near the end that changes how you look at every major decision in your own life, not just investing. Let's start with the boundary itself because everything else depends on it. Picture a large map. On this map, there is a small circle. Inside that circle sits everything you genuinely understand, not from reading a headline or hearing a friend's opinion, but from real, tested knowledge. Outside the circle is everything else in the world. Most people, when they look at this map, feel an urge to wander outside the circle because that is where the exciting stories live. New technology, fast-growing companies, industries that promise to change everything. Munger's first move is refusing to wander. He calls this staying inside your circle of competence, and the phrase sounds simple, almost too simple to matter. But notice what it actually requires. It requires admitting out loud that there are entire categories of business you will never fully understand, no matter how many articles you read about them. It requires resisting the pull of a good story. And it requires something even harder than that. It requires being comfortable watching other people make money in areas you chose to avoid. Think about how uncomfortable that really is. Imagine watching a friend get rich from a business you didn't understand well enough to buy into. Every instinct tells you to jump in anyway, to not miss out, to catch up. Munger and his longtime partner, Warren Buffett, were criticized for years for staying away from fast-moving technology companies during the dot-com boom of the late 1990s. Prices soared. Fortunes were made overnight. Commentators openly questioned whether the two of them had simply lost their touch, whether their old-fashioned approach to investing had finally gone out of style. Then the boom collapsed. Many of those companies that had no clear path to profit vanished completely, taking investor money down with them. The willingness to sit out, to say, I don't understand this well enough to risk money on it, turned out to be the very thing that protected them when the excitement turned to wreckage. That is the first purchase, before growth, before opportunity, before excitement. Munger buys clarity about what he does not know, and he pays for it with the discomfort of missing out. Here is the uncomfortable truth underneath this idea. Most financial losses are not caused by bad luck. They are caused by people investing in things they only partially understood while believing they understood them completely. There is a specific kind of danger in partial knowledge because it feels like real knowledge from the inside. You know just enough to be dangerous to yourself. A little bit of information creates false confidence, and false confidence is far more expensive than admitted ignorance. So the first question Munger asks is never, how much can I make? It is, do I actually understand this well enough to know what could go wrong? If the honest answer is no, the conversation ends there, regardless of how promising the story sounds. Now, once something genuinely sits inside the circle of competence, a second purchase begins. And this one surprised even his own investing partner. For years, the dominant investing style Buffett had learned came from his mentor, Benjamin Graham, a philosophy built around buying companies so cheap that even a mediocre business could still turn a profit for the investor. Buy things for less than they're worth. Wait for the market to notice, sell for a gain. It worked, but it had a hidden weakness. Cheap companies are often cheap for a reason. They tend to be tired businesses with shrinking futures. and buying them meant constantly searching for the next bargain. Since the business itself wasn't going to grow into something greater on its own, Munger pushed back on this approach. He argued for a different kind of purchase entirely, one that prioritized quality over price. The idea is captured in a principle now closely associated with him. It is far better to own a wonderful company at a fair price than a fair company at a wonderful price. Read that twice, because the two halves sound similar but mean something completely different. A wonderful company has what people now call a moat, some lasting advantage that protects it from competitors. Maybe it's a brand people trust without thinking. Maybe it's a network so large that competitors can't catch up. Maybe it's a cost advantage nobody else can replicate. Whatever form it takes, that moat means the business can keep charging fair prices, keep customers coming back, and keep growing for years, even decades. A fair company with no such protection might look cheap today, but competitors will eventually erode whatever advantage it briefly had. This shift in thinking changed real decisions with real money. One of the clearest examples happened when Berkshire Hathaway, the company Buffett and Munger built together, acquired a candy company called See's Candies in the early 1970s. By the strict bargain hunting rules of old school value investing, the price they paid looked too high for the physical assets on the books. But Munger saw something the balance sheet didn't fully capture: a brand people trusted, a habit customers had built over generations, and pricing power that let the business raise prices steadily over time without losing customers. That purchase became one of the most quietly profitable decisions in Berkshire's history, generating far more cash over the following decades than its original price ever suggested it could. The lesson buried inside that story is not really about candy. It's about recognizing that the real prize isn't a low price tag, it's a business durable enough to keep compounding value for a very long time. A cheap company you have to keep replacing is exhausting. A wonderful company you can hold on to does the work for you year after year, while you barely have to lift a finger. So the second purchase, right after clarity, is durability. Not this cheap, but will this still matter in 20 years? And will it still have the power to charge fair prices even as competitors try to take its customers away? Notice something about the order here. Price still matters. Munger never argued for overpaying recklessly, but price becomes the last question, not the first one. First you ask whether you understand the business. Then you ask whether the business itself has lasting strength. Only after both of those are settled does the conversation turn to what you're willing to pay for it. There's a third purchase that comes next, and this one is less about numbers and more about people, because even the best business in the world can be ruined by the wrong hands running it. Munger placed enormous weight on the character of the people managing a company. Not their resumes, not their charisma in interviews, but something closer to their honesty when no one is checking. He wanted managers who would tell shareholders the truth, even when the truth was embarrassing, who treated other people's money the way they'd treat their own family's savings, and who weren't quietly optimizing for their personal bonus at the expense of the business's long-term health. This is where one of his most quoted ideas comes in. A line so simple it almost sounds obvious, yet most institutions ignore it constantly. Show me the incentive, he'd say, and I will show you the outcome. People don't act according to their stated values. They act according to how they're rewarded. A salesperson paid purely on volume will push volume, even when it hurts customers. An executive paid on short-term stock price will make decisions that inflate the stock price this quarter. Even if it damages the company 5 years from now, that doesn't mean these people are dishonest. It means incentives bend even well, meaning people towards certain behaviors, often without them noticing it happening to themselves. So before buying into a business, Munger effectively bought a judgment about the people running it. Are they rewarded for building something durable or rewarded for making this quarter look good? Do they speak plainly about mistakes? Or do they bury bad news in confusing language? Would you trust this person to run your family's savings account, not just your investment portfolio? This third purchase, trust and character, rarely shows up on any financial statement. You cannot calculate it from a spreadsheet. It comes from paying close attention to how leaders communicate, especially during difficult years. Since anyone can sound trustworthy when everything is going well, the real test is how someone behaves and speaks when things go badly, whether they take ownership or look for someone else to blame. Now here comes a purchase that might be the most important one of all, and it happens entirely inside Munger's own head, aimed not at the business, but at himself. In a well-known lecture he gave, later studied widely by investors and psychologists alike, Munger laid out a long list of ways the human mind fools itself into bad decisions. He didn't present these as abstract academic theories. He presented them as traps he personally had to guard against every single day, because being intelligent does not make a person immune to these mental errors. If anything, intelligent people are sometimes better at constructing convincing reasons to justify a decision they already emotionally wanted to make. Take a few of the patterns he warned about. People conform to what others around them are doing simply because it feels safer to be part of the crowd. Even when the crowd is walking toward a cliff, once someone commits to a decision, they tend to stick with it stubbornly, even after new evidence shows it was wrong, because reversing course feels like admitting failure. A vivid, emotionally striking story gets weighted far more heavily than dry statistics. Even when the statistics tell the more accurate story, and once you like a person or an idea, you start filtering out anything that contradicts it, almost without noticing, so that favorable opinion protects itself from ever being challenged. None of these tendencies feel like mistakes while they're happening. That is exactly why they're so dangerous. A person caught in social proof does not think, I am currently following the crowd irrationally. They think, everyone else sees this too, so it must be real. A person caught in consistency bias does not think, I am refusing to admit I was wrong. They think, I've come this far. It would be foolish to quit now. The trap is invisible from the inside, which is precisely why it requires a conscious, almost ritual habit of checking your own reasoning before trusting it. This is the fourth purchase. Before trusting his own excitement about an opportunity, Munger bought a moment of suspicion directed at himself. He'd ask, quite literally, whether he wanted this to be true so badly that he might be fooling himself into believing it was true. He built the habit of imagining the opposite case as convincingly as possible, forcing himself to argue against the very idea he was excited about before allowing himself to commit any money to it. This habit connects to another idea closely tied to his name inversion. Rather than asking directly how to succeed at something, he'd often flip the question and ask how he might guarantee failure. Then work backward from there to avoid those exact mistakes. If you want a long, healthy life, don't just study what healthy people do. Study what destroys health and avoid doing that. If you want a strong investment record, don't only study great decisions, study catastrophic ones, and structure your own approach to guarantee those specific failures never happen to you. Apply to investing. Inversion means before asking, how could this make me rich? Munger would ask, what would have to be true for this decision to destroy my capital? If the answer to that second question felt uncomfortably plausible, the excitement from the first question no longer mattered. So far we've covered 4 purchases made quietly and in this order, long before any money physically changes hands, clarity about what you truly understand, confirmation that the business itself has lasting strength, trust in the character of the people running it, and a deliberate, almost adversarial check on his own reasoning to catch himself before his own excitement could override good judgment. There is a 5th purchase, and it might be the hardest one of all, because it doesn't feel like doing anything at all. It feels like doing nothing for a very long time, while everyone around you appears to be moving. Munger and Buffett often describe their approach using a baseball analogy. Imagine standing at the plate with no limit on how many pitches you're allowed to watch go by. There's no penalty for letting 100 pitches pass without swinging. In ordinary baseball, 3 strikes and you're out, which forces hitters to swing at decent pitches out of necessity. But in investing, there is no such rule. You can simply stand there, patiently letting pitch after pitch go by until one arrives that is exactly, unmistakably, the kind of pitch you know how to hit well. This patience is a purchase too, an active choice, not a passive absence of action. Munger reportedly said the big money isn't made in the buying or the selling, it's made in the waiting. That single idea runs completely against how most people are wired to behave with money. Watching your account sit still while others chase the latest exciting trend feels like falling behind. Every fiber of ordinary impulse screams to do something, to act, to not miss the moment. Patience, real patience, sitting through years of tempting but flawed opportunities while waiting for a truly excellent one, is an act of discipline most people never build the muscle for. Think about how this shows up practically. Over a long career, Munger and Buffett made relatively few enormous decisions compared to how often professional fund managers trade. Long stretches passed with barely any major moves at all. To an outside observer unfamiliar with the underlying philosophy, it might look like laziness or even a lack of ideas. In reality, it reflected exactly the opposite. A refusal to swing at a mediocre pitch simply because standing still felt uncomfortable. Now, put all 5 of these purchases together in the exact order they happen, and you start to see the entire philosophy laid out clearly. First, by clarity, an honest boundary around what you genuinely understand. Second, by durability, confirming the business itself as lasting strength that will still matter many years from now. Third, by trust in the character and incentives of the people actually running things. Fourth, by suspicion of your own excitement, actively hunting for reasons you might be wrong before committing anything. And fifth, by patience, the willingness to do nothing at all until a genuinely excellent opportunity finally appears. Only after all 5 of those purchases are made does price even enter the conversation. Most investors run this process completely backward. They see a price moving quickly, feel a spike of excitement or fear, and only afterward try to justify the decision with a story about clarity, quality, trust, and patience they never actually possessed. Munger's entire approach was a refusal to work in that order. Everything meaningful happens before the money moves, not after. Here's something worth sitting with, because this idea reaches far beyond investing accounts. Think about the biggest decisions in your own life, not stock purchases, but the ones about careers, relationships, or years spent pursuing a particular path. How often do people commit fully to something first, driven by excitement or fear of missing out, and only afterward try to convince themselves it was the right call? A relationship entered quickly, because it felt thrilling in the moment without a clear, honest look at whether the two people's values actually aligned for the long run. A career chosen because it looked impressive to other people without an honest check on whether it matched genuine strengths and interests. A major life decision made because everyone else seemed to be doing the same thing, and standing apart from the crowd felt uncomfortable. The 5 purchases Munger made before spending a single dollar apply almost perfectly to decisions that have nothing to do with money at all. Do you genuinely understand this situation, or are you operating on a partial picture that merely feels complete? Does this choice have lasting strength, something that will still hold up in 10 or 20 years, or is it built on a temporary spark that will fade once the excitement wears off? Can you trust the character of the people involved, especially in how they behave when things get difficult, not just when everything is easy? Have you honestly searched for reasons you might be wrong, or have you only gathered evidence that confirms what you already wanted to believe? And finally, are you willing to wait patiently for the right opportunity rather than swinging at whatever pitch happens to be in front of you right now simply because waiting feels uncomfortable? That last one might be the hardest lesson buried in this entire way of thinking. In a world constantly pushing urgency, constantly insisting you must act now or lose your chance forever, choosing to simply wait, letting dozens of mediocre opportunities pass by without swinging, takes a kind of confidence most people never develop. It requires trusting that the right opportunity really will come eventually, and that chasing every passing pitch out of fear of missing out is often exactly how people end up with a record full of regrettable swings. Munger lived long enough and stayed sharp enough to prove that this order of operations works, not through luck repeated over and over, but through a discipline applied consistently across an entire lifetime. Clarity first, quality of the underlying thing second, trust in the people involved third. Honest suspicion of your own excitement fourth, patience through the waiting fifth, only then price. If there's one thing worth carrying with you after this video ends, let it be this: the most important purchases in life are rarely the ones that show up on a receipt. They're the quiet decisions made beforehand, the honest boundaries drawn around what you truly know, the discipline to wait for the right moment instead of chasing every moment that merely feels urgent. Munger spent a lifetime buying those things first, long before he ever reached for his wallet, and it's exactly why the purchases that came after tended to work out so well. If this way of thinking resonated with you, consider staying close by subscribing, since there's a great deal more of this kind of thinking worth exploring together. But whether you do that or not, carry this one idea forward into your own decisions, in markets and far beyond them. Buy your understanding before you ever buy the thing itself.